It's artificial intelligence, and Salesforce is the one behind it. This is the key to enterprise artificial intelligence. I think you could make an argument that this could be the ChatGPT moment. We'll find out in a couple of months if this actually turns out to be the ChatGPT moment for companies. Welcome back to the Daily Peels Daily Podcast of the Day, apes. Thank you all for joining us here once again on the world's most popular and influential podcast. We're very glad to have you here with us on this beautiful Thursday, September 19th, 2024. Apes, it is currently 6:06 p.m. We got a lot to talk about here today. Very good session in markets here. So we were very glad to see it because leaving yesterday, after the rate cuts came in, markets were a little bit pensive. They weren't too sure exactly what to do going forward. It seemed like we were taking some time to kind of digest the numbers before going absolutely off to the races here today. The NASDAQ up 2.51%, the S&P 500 up 1.7%, led by large cap tech stocks. We had Apple up 3.71% today. We had Nvidia up 3.97%, Meta up a solid 3.93%, and Tesla up a huge 7%. That last one is the only one that we're going to be talking about in depth here today. But if you want our thoughts on any of these others, of course, feel free to write into us, David@WallStreetOasis.com, write in the comments. Like, subscribe, do everything to boost our algorithm so that I can keep my job and we can keep producing the world's most popular and influential podcast. Now, the WSO Alpha portfolio had a relatively solid day here too. We were up 2.04%, led of course by one of our larger holdings in Tesla, but somehow we still managed to underperform the Russell 2000. The Russell was up 206 basis points or 2.06% here today. So we did outperform the S&P 500 and the Dow. The Dow was up 1.26%. Not that anybody cares or should care. So that brings the WSO Alpha portfolio, our proprietary investment portfolio, to a return of 13.76% year to date. Not very good, definitely not terrible either. We're not proud of it, and I'm going to fire somebody at the end of this quarter here once again. Nothing I love more than getting to fire people. So at the end of September, we'll see whose heads are getting cut. Maybe I'll take a vote from the audience here, and you guys can help me decide whose livelihood I'm going to end going forward. All right, let's go ahead and get into some of the big stories here today. We got a lot to talk about, post-Fed rate cut. We got one more trading day here this week, and then the weekend we'll kind of digest and see what's popping going forward. We got a bit of a quiet week next week in terms of economic news, but we'll be talking early on Monday about housing sales, about manufacturing, CapEx spending, all that good stuff that I'm sure you guys are just dying to hear about. Okay, let's go ahead and get into some of the banana bits here today. First of all, Daily Chart Book. Absolutely love this Twitter account. Go subscribe to it, go follow it, go fucking subscribe to their newsletter as well. They produce a bunch of charts and you can get like 5 of them for free. And then if you do the paid version, which is, a couple $100 a year, way above my bank account personally, and probably, just take the inverse of the amount, put that as negative. That's probably what's in my bank account right now. But still, go ahead and check out Daily Chart Book because they put together some of the best charts out there. This one was great because the first link in the Banana Bits tomorrow is going to show you what the average FOMC participant is thinking about rates, inflation, unemployment, GDP going forward. So get a good summary of what the Fed is thinking right now by taking a look at that chart. Next up, FedEx dropped its earnings today, and I'm sure they regretted it immediately because in addition to failing to deliver several packages that I am still waiting for, they also forgot to deliver strong earnings. So rough quarter for the second largest delivery, or third largest because Amazon Prime is now number one, delivery system in the United States. Very rough time to be number 3. Now, it's also a tough time to be number 1, especially if you are in the shoe sector or the apparel sector more broadly, because Nike has been having a rough go of it. Let me see what Nike's year-to-date return is so far this year, because holy shit, it has been absolutely embarrassing. Now, they did pop after hours, and I'll tell you why in a quick second. Jesus Christ, down 14.4% this year, since peaking back in, looks like November of 2021. The stock is down, holy shit, 54.38%. Nike completely falling apart, shedding a lot of market share to companies like On Running, like Allbirds, like Hoka, like all of these different companies that, Gen Z doesn't really give a good goddamn about brands. Like millennials were huge on brand affiliations. Gen Z wants kind of the exact opposite. They want something that nobody else knows about. So going to Nike, that's not really going to be a popular spot for people in that generation, or at least the Gen Z heads among Gen Z. I'm personally Gen Z myself, but would absolutely shoot myself if anybody told me, you seem like you're from Gen Z. God damn it, that would end my career and maybe my entire life. Nike did just appoint a new CEO, though, that they're really hoping to kind of turn things around and, lace him up and start to put the shoe back on the right foot, if that pun happens to work there. Anyway, let's go ahead and move right along from that. The nation's largest home builder, Lennar, did deliver relatively strong earnings. The market wasn't too impressed, at least when I looked at this immediately after they reported. So let's go ahead and see what the after-hours return is right now. Since 4 p.m., the stock is down 2.83%, certainly picking up from a 4% decline. So, kind of turning around once again. Prices were fine. Deliveries weren't as strong. Once again, we'll be talking about home sales tomorrow and how they declined in August and really broadly throughout the second quarter, despite pending rate cuts. So we'll be getting into exactly what all of that means for the economy tomorrow. You guys will see it on Monday, but we'll be writing it tomorrow. Finally, FactSet just released their latest M&A review for the month of August. It shows that it was a bit of a dry spell, which is unusual because we just talked about recently how strong Q2 was. So the period of April, May, June, absolutely fantastic for M&A, especially in the financial technology sector, aka fintech for all the cool kids out there. Total M&A, however, did fall off a very small cliff in August. It's one of those cliffs you would fall off. You might just break your legs. You might not die completely. So mergers and acquisitions, they're definitely falling off just a little bit in August. My guess is that people are probably putting things on hold before taking out additional debt financing in order to fund these acquisitions until rates actually declined, and that's exactly what we saw yesterday. So it'll be interesting to see what the September numbers look like, and especially October. Now, if October is still depressed M&A, we might be in a little bit of trouble. But before we make any determinations on what's going to happen in the mergers and acquisitions market, we have some business to take care of here, Abe. So yesterday, there was a lot going on. The Fed cut rates, they released their summary of economic projections. J-Powell's press conference gave us a lot of great quotes. So we wrote a fucking book about what was going on yesterday at the Federal Reserve. Today, we want to kind of streamline it a little bit more and talk more so about the implications that a rate cut actually brings. Now, it seems like a lot of the time when analysts, and especially when, financial market pundits on CNBC or something, talk about these rate cuts, a lot of the time it seems like it's just some kind of magical automatic mechanism, rate number go down, stock go up. That's the kind of thing, that's the picture that they paint there, but very much not what's actually going on under the surface here. So that's what we want to talk about here today. What's going on under the surface, why there are long and variable lags, what this means for stocks, credit, other assets, the US government going forward, because holy shit, there's few things that you can do that would impact an economy more, or really a country more, than lower its interest rate. So let's talk about it. First of all, we have to understand, interest rate cuts, the day that they happen, it's kind of like your birthday. Allegedly it's a big deal. You look forward to it for a long time, but then afterwards you kind of leave wondering, did anything really happen? I'm sure when you turned 17, somebody said oh, you're 17 now. Do you feel much older and wiser than when you were 16? It was probably your drunk uncle, but still the sentiment remains the same. Obviously, you don't really feel the same feel any different despite the anticipation going into the event. The only difference between rate cut days and birthdays is that rate cuts are actually worth celebrating because it's something that you've earned, not that you've earned, but the economy overall has earned and, could actually bring positive outcomes rather than just causing you to have a pre-midlife crisis, especially when you turn 30 or something like that. But anyway, yesterday, if Wednesday's Fed meeting was if you were going to call Wednesday's Federal Reserve meeting an episode of the most overrated TV show in history, Friends, it would be called The One We've All Been Waiting For. And that's exactly what we got. So the Federal Reserve cut by 50 basis points. Now, that was larger than the typical 25 basis points that they do most of the time in history. If you look throughout, past 50 basis point rate cuts, most of the time, these are going to happen during a period that we're already in a recession. Now, objectively, that is not the case right now. The U.S. economy is nowhere near a recession. We're firing on all cylinders, and the Federal Reserve is still cut by 50 basis points. A little weird. Let's talk about exactly why that is. Well, before we do, let's talk about some of the positioning of the market compared to the Federal Reserve going forward. So the market, as of Monday of this week, was anticipating a 50 basis point cut. It took them a little bit of time, but they did get caught up to speed and kind of on board with what the Fed was ultimately going to do. Now, we have a chart here that we're showing in the piece, and hopefully on either side of me here today, that's going to show the trajectory going forward through the year-end 2027 of what the Federal Reserve expects compared to what the market expects and the spread implied by these expectations. So at the end of 2024, the Fed is looking at rates to be around 4.5%, whereas the market is looking closer to 4%. Now, at the end of 2025, the Fed is looking for somewhere around 3.25 to 3.5%, whereas the market is looking closer to around 2.75 to 3%. So the spread is actually getting a little bit wider going into 2025. Now, you might say it's farther off in the distance. Doesn't that make sense? Well, Not really, because typically when you're talking in economics and you say long term, long term in the world of economics is anything beyond 1 year, anything that won't change within the next year or so. And so when we talk about year-end expectations of 2025, obviously that's long term because it's more than a year away from now. Typically, when you're talking about long-term expectations in economics, people's estimates kind of coalesce together, especially when it's something like interest rates that's relatively standardized in the past. It's not going to be something like, what's the size of our GDP at the end of any given year, but it would be like, what's the growth rate? It's something that has such a large population that we can kind of derive its sample size from there, and ultimately we all come to similar conclusions. Like, if the natural rate of interest is typically, somewhere around 2.5%, 3% or so, long-term expectations for me, you, 𝗟𝗡𝗚, are probably going to be for rates to be somewhere around the 2.5% mark. So seeing that they're widening in 2025 is very interesting. They do narrow a little bit for 2026 and 2027. We don't really have to worry about those as of right now at the very least. This spread and the widening spread going into 2025 is guaranteed going to assure that we are going to experience volatility in markets going forward. Now, volatility doesn't mean bad. Volatility just means there's a lot of movement. It could be up, it could be down, it could be, I guess those really are only two options there. But still, it could be up, it could be down. And this volatility is going to be born out of the probabilities or the kind of narrowing of end-of-year expectations for 2025. So if the Fed acquiesces to the market and their expectations for interest rates start to lower, that's obviously going to be beneficial for equities. Whereas if the market starts to acquiesce to the Fed and realizes, okay, we're going to have to keep higher for longer, a little bit higher for a little bit longer, then that's not necessarily going to be great for equities going forward. But this is going to be one of the top things to watch. So be paying attention to the dot plots. We'll get another one in December, and then March, and then June, and then September. And then we'll have some idea of what's going to happen at the end of 2025. As of right now, it's not even worth us speculating whatsoever. Now, of course, even though it's not worth it, I'm going to nonetheless. I think that by the end of this year, I think the market's going to ultimately be proven correct. Now, the reason that I think so is the basic conversation of decentralized planning versus centralized planning. Centralized planning is the Federal Reserve saying, like, we think this will be correct at this time in the future. Obviously, we're not making any decisions right now, but this is our guess for what's going to be right going forward. Whereas the market is a distributed algorithm basically saying, like, all of our individualized guesses added up sum to whatever the number is. In this case, at the end of 2025, that's going to be somewhere around 2.9%. So in that range of 275 to 300 basis points. So my money would be on the market. Based on this, it's probably going to be somewhere between 300 and 325 by the end of 2025. Probably somewhere between 425, 450. We'll definitely be in the 400 to 450 range by the end of the year. I'd be very surprised if we're not. And it's going to be interesting to see what kind of effect that's going to have on equities markets. Now, the mechanism that this actually goes through, that this works through to have an impact on equities markets, is typically going to be through the credit side of businesses, but it largely depends on the size, scale, and cash flows of your business. If you are an unprofitable tech stock, now, declining rates is going to be great because lower interest rates are good for longer duration stocks. Now, longer duration basically means it's going to take a longer amount of time for you to get your initial investment paid off, whether through dividends, returns, whatever it might be, in the case of equities. So when interest rates decline, that means the total discount rate that's going to be applied to those future cash flows is going to decline. And because those cash flows that you're expecting are so far out in the future, the discount rate applied is going to be much more impactful. It's going to be exponential. Basically, the farther that you go out in the future, it's literally exponential. There's an exponent in the formula. So that's kind of one of the biggest things of how it's going to impact companies that are, that are those long duration companies. Now, on the smaller cap side of things, if we talk about Russell 2000 stocks that are probably profitable, but not necessarily like, large companies, the primary mechanism that interest rate declines are going to work through is through the cost of borrowing that these companies face. So if you're a smaller company, you are not getting like a AAA rating like a Microsoft or anything like that. So your interest rates are actually going to have some kind of a spread over treasuries. Whereas Microsoft, Apple, they're roughly in the same ballpark as those because they're seen as just as reliable, if not more reliable than the US government, especially right now. Smaller cap stocks aren't that reliable, so they tend to get a higher yield. That kind of makes it, more worthwhile for risk on investors. But still, when those interest rates come, that's going to have a multiplicative effect on those yields. So that's kind of how it works through. And then the ultimate mechanism for kind of large cap blue chip stocks that we all know is investments. This allows them to invest a little bit more in, CapEx spending, whatever it is that they're looking for, whatever they want to invest in. This lowers their hurdle rate, so it means that they can invest in more things. That's kind of the primary mechanism, at least how it works through equity markets and those different kinds of companies. You could break this down into an infinite amount of ways, but those are kind of the three broad strokes that we're looking at for at least the stocks that we tend to follow. Now, if you look at other markets, and arguably much more important market, especially to the day-to-day lives of the entire global population, the US dollar and its impacts on the dollar are going to be much more important. So if we take a look at the past year or so, you can see that the US dollar has been in almost constant decline for that period, despite a rise from, early 2024 through about May. The decline has been clear because markets are pricing in these rate cuts. Now, the reason that the dollar will decline when rate cuts come in is because typically you're going to earn a lower yield on the fixed income investments in that country. So, there's less demand for dollar-denominated fixed income assets. So that's kind of the ultimate mechanism that brings down the price of the dollar right there. There's less demand. Obviously, the price is going to fall. But a weakening dollar is going to have much more of an impact than just, kind of the price that you see on a screen in and of itself. First and foremost, when it comes to exports, net exports, this is a key factor in the GDP equation. So when we see the dollar decline, that means we're going to have to pay effectively a higher price for foreign goods because our dollars go less far of a way to do so. If the dollar one day is worth €2 and then it's worth €1 the next day, you're going to require $2 more to get €1 in that case. Now, it has the exact same implication on imports. So that basically means that, it has the exact same implication on exports, So on the export side, it's going to make U.S. goods more competitive on the global stage, whereas imports are going to become a little bit more expensive. Now, especially when you pair that with tariffs that a certain presidential candidate has been talking about, that is a very inflationary mechanism. Now, that might sound weird because it's, rate cuts, and the whole reason that we're doing rate cuts is because we think inflation is done and there's not much of a risk to go back. This is the risk that they're talking about right here. This is how you re-trigger inflation, is by increasing the price of imports, especially when tariffs are added on there. You could increase the overall prices present in the entire economy. Now, at the same time, when we look at the capital and financial account, you're looking at lower demand for U.S. Treasuries because there is a lower yield. We've already started to see expanding tails on U.S. Treasury auctions. So this is a concerning mechanism because that means that despite the fact that rates are going lower, the ultimate market-based spread that the Treasury is going to have to pay could increase if demand weakens by enough where its magnitude outstrips that of the rate cuts themselves. You could see continued challenges in funding for the Treasury Department and thus the U.S. government. Now, similarly, reduction in the trade deficit is absolutely possible because of what we just talked about. You get headwinds on imports and tailwinds on exports. That's going to be good for net exports, which is ultimately going to help GDP. It's going to reduce the trade deficit as well. But other effects, like you get implications for the J-curve effect and variable impacts on, other factors in the capital and financial account, like investments in equities, in gold, and hard assets like real estate or something else like that. Those are going to be much more variable. So really, it's a question of magnitude going forward. The reason that I'm kind of rambling so much and that we're already 17, 18 minutes into this right now is because I want to talk about all of these different effects. And, that I know I just rambled there. So go ahead and rewind if you didn't understand the first time around. I probably wouldn't even understand if I watched this back here, to be honest with you. But the reason that we're doing this is because I want to say it's much more complicated than just rate cut stocks go up. There's a whole lot of implications that we want to talk about here. And I know a lot of you guys are still college students and everything. So, of course, we want to make sure that you're getting the full picture because your teachers are probably going to want to keep it simple so that they can go over their smoke break and get back to their families soon enough. Now, the interesting thing about this is that 50 basis points, yes, it's a large cut, but in the grand scheme of things, rates are still extremely high. Now, if we compare this to the past decade or so, we're still more than triple the average rate. The average rate over the past decade prior to the pandemic was 1.8%. We are now at 4.75%. So we're still near fucking triple that amount, definitely more than double. Not really near triple would be, 5.4% or so. Obviously, we just came down from that level, but still, it's very high compared to history. So we're expecting a lot more rate cuts and other steps to loosen monetary policy to be coming on the heels of this rate cut. But still, that's kind of the implications that we have going forward. Jesus Christ, that took way longer than I expected. Let's go ahead and move into some of our big stock movers of the day. First of all, we have Darden Restaurants. This stock was up 8.25%. This is a restaurant holding company. They own some of the most iconic American brands out there, such as Olive Garden, is kind of the only one that I can think of. Capital Grille, Eddie V's, because they have those written in the piece here. Can't think of what the other... Longhorn Steakhouse is another big one. They have a bunch of these different things. Darden wasn't looking too good last quarter. Basically, all of their brands saw declines in their same-store sales. Now, every single one missed. And so we had Capital Grille and Eddie V's. These are the fine dining segments within Darden. These were down the most. They were down a combined 6% in terms of same-store sales. Longhorn Steakhouse was the only one that was up 3.7%. Even Olive Garden. How is this possible? I guess we just don't like breadsticks anymore or something, but Olive Garden same-store sales fell 2.9%. So it was a very ugly quarter. Ultimately, they missed on both sales and EPS estimates. But see again, the stock was up 8.25%. Why? Well, a partnership with a flashy, sexy tech company can cover up any fundamental losses. This is proof. This is like the epitome of proof that all the market cares about is what's going to happen going forward. So this past quarter, it's in the past. Who cares? This is stuff that's already been priced in and is certainly priced in after the quarter is over. But Darden announced an on-demand partnership with Uber, which effectively means that Uber is going to be prioritizing orders from Darden to be able to get them to customers a lot faster. When I say Darden, I mean Darden-owned brands. Investors were pretty fired up about that because they're expecting an increase in orders coming from the mobile segment. And that's always ideal. It should be a pad on margins. All right, moving into our second stock mover of the day, we have Tesla. Now, you might have heard of this company before. Tesla is an automaker, I believe. Some guy named Elon Musk founded it or something like that. But either way, the stock was up 7.36%, and this goes back to what we were just talking about with relation to long-duration assets. Tesla is the epitome of a long-duration stock. Although they are profitable and generate massive amounts of free cash flow, the thing is, a lot of this company's, in its current valuation, a lot of its current valuation is baked into future cash flows and future earnings. So when that discount rate factor is going to be declined, that again brings that exponential effect on the value of those future free cash flows, and suddenly the net present value is a lot higher than it was when the discount rate was just a couple of basis points higher. Plus, at the exact same time, Tesla is an automaker. Automakers, I don't know if you heard, but typically most people, when they go and buy cars, they're doing so through credit. Most of us aren't just going down there, writing a fucking check and walking out of the dealership all fat and happy. Most of the time, you're going to be taking out some kind of a loan in order to finance these things. So with the cost of borrowing declining, the expectation is that interest rates declining are going to motivate additional vehicle purchases. All right, let's go ahead and move into our stinky, rotten movers of the day. First and foremost, we have Trump Media and Technology Group. God damn it, this fucking company, quote-unquote company, because this is not a real company by any stretch of the imagination. Basically, what happened today is this was the 180th day since DJT, or Trump Media and Technology Group, merged with DWAC back in March of last year, or March of 2024, I should say. Since they merged, there has been a 180-day waiting period before insiders can start to sell stock. Insiders meaning somebody who owns more than, a certain percentage or is heavily involved as an employee at the company. So, who is an insider for Trump Media and Technology Group that you might know? Might be a big name in the media. Do any guesses come to mind? Obviously, former President Donald Trump is at the top of the list. This guy owns a roughly 57% stake in the overall business. And I don't know if you guys have heard, I just found out about this here today because absolutely nobody talks about it. No mainstream media outlet talks about this stuff at all. But apparently, Trump has been going through some legal challenges lately. And as such, the market thinks that he might need to get a little bit of cash. So they're expecting him to start selling when insiders sell. Obviously, it's not a great sign for the company going forward. Now, last Friday, President Trump did come out and say that he promised he wasn't going to sell his shares, to which the markets responded in the exact same way that they have been responding to DJT shares the entire time it's been public, in saying we are not buying it. And that is exactly what they did yesterday. The stock was down 5.89%. All right, moving on down, our last stock mover of the day, we have Five Below. I can't believe that's not referring to the company's share price at this point. But either way, it absolutely is not. JP Morgan, though, is out here trying to make sure the share price goes below 5, out here downgrading the stock. Basically, what happened is Five Below, this is a discount retailer. They are a dollar store, but a $5 store instead of a dollar store. So most of their products are going to cap out at $5. They have a luxury segment where if you can, swing it, if you're a high roller, not like me whatsoever, but if you're a big high roller, you can afford $25 purchases. They also have those too. So that's going to be the maximum there. But being a discount retailer, they've struggled with inventory management over the past couple of years. They went balls deep into a lot of inventory in 2021 and 2022. Since then, things have not exactly flown off the shelf exactly how much they expected. So they're taking a lot of hits on earnings with inventory write-downs. That is leading to exactly what I just said, a lot of hits on earnings. But at the exact same time, lower basket sizes have also been coming into question. So, going into this period prior to the rate cut where we all thought a recession might be looming, as kind of everybody has thought so far in 2024, you could make the argument that dollar stores are going to be great because they're going to attract a set of new buyers that are looking to save some money. Instead, what's actually happened is that it looks like dollar store customers and those of Five Below are instead not attracting new customers, and they're having a tough time retaining to their old customers. And those old customers, nonetheless, they're coming in and they're purchasing total baskets of goods that are smaller than they used to, at least prior to, coming into 2024 at this point. So those two things combined, it's going to be, a lot of inventory heads weakening margins. Basket sizes are going to be on the decline as well. Unfavorable leadership changes. JP Morgan overall doesn't like it. They downgraded the stock and now rate it underweight. All right, moving into our last segment of the day here, our thought banana. Turns out South Park was right. Really, when are they ever wrong? But in this specific incident, South Park was very right that they are coming to take our jobs, or to quote Randy Marsh directly, they're coming to 𝗥𝗢𝗟𝗘𝗗𝗗. I believe that's exactly how he said it. But they were exactly right. The only problem is that they were a little bit off on who, or in this case, what is coming to take your job. In this case, it's artificial intelligence, and Salesforce is the one behind it. This is the key to enterprise artificial intelligence. I think you could make an argument that this could be the ChatGPT moment. We'll find out in a couple of months if this actually turns out to be the ChatGPT moment for companies, but still, it certainly seems like a strong candidate. So, Salesforce CEO Marc Benioff, he gave a recent interview at the All In Summit, which is All In is a podcast, and I think it's like a growing media outlet that a bunch of VCs put together. I personally love the show. I think you guys should check it out too. So I was listening to this interview with Marc Benioff, and he goes full fucking comedian mode, making jokes left and right for the first, half of the interview, basically the first half hour at the very least. Then he starts to kind of segue into talking about Agentforce, which seems to be the only real reason that he was actually part of this conversation. But Agentforce, pretty sick, and I can understand, if there's only going to be one reason to go to a conference and talk about something, especially when you're pumping your own company's products, this product is it. Agentforce, essentially, this is a new platform offering by Salesforce in which companies can get access to and deploy autonomous artificial intelligence agents to assist with a plethora of business functions. Some of the biggest things that they would do is, you could basically, for example, if I was using a Salesforce agent, I could say, hey, go gather data on past Federal Reserve interest rates cuts and build me a chart that shows the different paths that the S&P 500 has followed in the 18-month period following the start of a rate cutting cycle. Something like that. It could go out, gather the data, build the charts for me, and send it right on back while I'm out here opening another beer or something, whatever else I want to be doing at that time. So this agent is going to do a lot of the work for me, and it's going to do a lot of the work for these companies going forward. Now, the company plans to use a consumption-based model. I saw reports were saying that it was like $2 per conversation or so, and then obviously it's going to scale up with, if you're having like a Wall Street Oasis or something, maybe it would be $2 or $1.75 per conversation, but an Apple might be something like 50 cents or so. So it's still going to have that kind of bulk discount. You're also going to be able to access this through third-party partners that can kind of further customize agents for extremely specialized different tasks. The agent can also embed into existing Salesforce products. So your sales, your marketing clouds, anything like that, it can go into these CRM systems that you have. Like say you have a relationship with a client that you've had for the past decade or so. You probably have a repository of data stored on your past conversations. You could go ahead and tell this AI agent to go ahead and read those conversations, come back on recommendations for a new product that you want to push to this customer or something like that. So basically, this will give companies and every employee that uses them a personal assistant 24/7, 365. They don't even ask to take off New Year's Eve. Absolutely amazing. Can't imagine an employee like this. And they're all going to be coming for us. This is the kind of use case that, Bitcoin NFTs wish that they had. And artificial intelligence, like we've been talking about this whole time, this is absolutely not a bubble whatsoever. The implications here are going to be huge. You need a Microsoft Office of artificial intelligence. There's going to be one of those things out there that absolutely every company has to use in order to get with the times, and this Agentforce could be an early candidate for that lead. Now, a big question, and one that MIT was posing that I think factors into this conversation well, is if these artificial intelligence systems and your utilization of them with in your job responsibility is going to be more cyborg or more centaur. Now, I thought this was an interesting analogy. A cyborg or cyborg behavior basically says that the way users, quote, intertwine their efforts with artificial intelligence. So you're working kind of together with artificial intelligence. You're initiating a sentence, the AI is going to complete it. That's the example that they give here. Whereas centaur behavior is more like some things are human-based and some things are artificial intelligence based. Personally, at least for, a lot of entry-level jobs, it's going to be very much centaur based, where it's saying things like maybe you have this AI do basic data entry while you're talking to customers, at least for the time being. I'm sure artificial intelligence is going to get to the point where it's able to replace those customer service agents, but still, maybe that'll be kind of the last respite of entry-level jobs. Those are going to be looking very different going forward. I just wish we had this during the work from home period in the pandemic. Remember, everybody was working 2, 3, 4 jobs and working like 10 hours per week at each and absolutely raking it in. With this, you could be like that guy in Office Space, but for the entire SP 500, and you just sit there, collect checks while your agents are out here doing all of the work for you. So our only question is, will Agentforce, is this actually going to be the ChatGPT moment for companies? What other artificial intelligence services could claim that title going forward? And that about does it for us here today, apes. I know we are going over a half hour now. Jesus Christ, that means I'm going to be in trouble, and I apologize for it, but I think it was worthwhile to talk about all the implications that rate cuts are going to have across different asset classes, what this means for the economy going forward. We do want to finish it with a quote related to artificial intelligence, because that was the last thing that we talked about here, from Mr. Peter Thiel. He came out here and said, "People are spending way too much time thinking about climate change, way too little thinking about AI." Greta Thunberg is fired up about that comment, even though I'm pretty sure this is from like 2019, but still, it still absolutely rings true today. If anything, we're probably still discounting the ultimate impacts that artificial intelligence is going to have, not just on NVIDIA's income statement. It's not always going to be just buying chips and chips and chips. Now, that might be what I do after I eat dinner, is just fucking house chips, but companies aren't going to be doing that for, the entire rest of their existence. There's going to be a point where we kind of say, okay, we have enough. But the question is, what's that next big thing? What's that, kind of upper layer in the stack that dollars are going to be moving to next? Maybe it's Agentforce, maybe it's something else. Maybe I have no idea what I'm talking about. Either way, that last part is definitely true, but let's go ahead and end it off for today before we hit fucking 45 minutes, because Jesus fucking Christ, I can't believe it's been this long already. Thank you guys for joining us as always. Like, comment, subscribe, shoot me an email, whatever you want to do. Tell me how great my hair and mustache look today. Always love seeing those kinds of comments out there. And otherwise, apes, we will see you guys at the beginning of next week. Have a wonderful weekend out there. Happy investing, happy trading, and bye now.